Okay, let's dive right in. We're going to look at one single company that some of the smartest investors on the planet are betting billions on. So, what is it? And more importantly, what did they see that most of us might be missing? Just think about that for a second. Imagine a business that gets a small cut basically every time money moves, every time economies grow, or anytime a company needs to raise cash. A business that is absolutely essential, pretty much unavoidable, and wildly profitable. Well, here's the thing. That's not some hypothetical fantasy. A company like this is very, very real. And today, we're going to break down exactly how it works and why it's become a cornerstone in the portfolios of some of finance's biggest titans. So, let's start with the secret itself. Who exactly is betting so big and on what? The company is S&P Global. You probably know it by its ticker symbol, SPGI. And listen, we're not talking about small bets here. We're talking about heavyweight managers like Chris Hohn and Dev Cantaria who handle billions, making this a massive position for them. So you have to ask, why this company? What is the special sauce? Well, the answer really comes down to this super powerful concept, something that analysts like to call a legal monopoly. Now, hold on. To be super clear, we're not talking about anything illegal. This isn't about some shady backroom deals. It's about building a business with such a deep and wide economic moat that it's almost impossible for new competitors to even get in the game. It's like a fortress built on trust, data, and just being woven into the fabric of the market. And S&P Global's fortress? It's really built on three enormous pillars. If you understand these three things, you'll get the entire investment thesis. First up, pillar number one, ratings. You see, S&P, along with its main rival Moody's, they basically have a stranglehold on the market. It's a duopoly. If a huge company or even an entire country wants to issue debt, they need to get a stamp of approval from one of these two. This creates an insane barrier to entry. I mean, think about it. You can't just wake up tomorrow, start a new ratings agency, and expect the entire world to trust you. It's just not going to happen. And this gives them something called pricing power. They can pretty much raise their fees whenever they want because their clients, well, they don't really have another choice. Okay, the second pillar is all about indexes. This one is so simple, it's brilliant. Just think about the S&P 500, right? Every single time you or I or anyone buys a simple S&P 500 index fund or ETF, the fund manager like Vanguard or BlackRock has to pay a tiny little licensing fee to S&P Global. And with the absolute explosion in passive investing over the last decade, this has become a massive automatic river of cash flowing straight to them. They don't have to sell anything new. As long as people keep investing, S&P gets paid.
Now, the third pillar, man, this might be the most powerful one in today's world. And this quote just absolutely nails it.
And this quote is talking about their huge move into data and analytics. After they bought IHS Markit, their platforms like Capital IQ became deeply, deeply embedded in the daily work of banks, hedge funds, and major corporations. Once a company builds all of its financial models and processes around S&P's data, the cost and, frankly, the sheer headache of trying to switch to a competitor is just way too high. It's an unbelievably sticky business. Of course, you can't really talk about S&P Global without bringing up its lifelong rival. And actually, looking at their differences really shines a light on what makes S&P's strategy so unique. So S&P Global's main competitor is Moody's. While they're both absolute powerhouses in ratings, their strategies are starting to diverge. You could say Moody's is more of a purist choice. It's a very focused bet on the continued growth of global debt. S&P, on the other hand, is playing a much bigger game. It's trying to become the central nervous system for what it calls essential intelligence, providing not just financial data, but all kinds of critical industrial data too. So when you put all these pieces of the puzzle together, the ratings, the indexes, that super sticky data, you finally start to see the whole picture. This is the crucial point right here. Investors like Chris Hohn don't see these as just regular companies. They see them as toll booths built on the highway of the global economy. Whether the economy is booming or just kind of chugging along, capital has to move, debt needs to get issued, and data has to be analyzed. And guess who's there to collect a little fee every step of the way? S&P. And you might be asking, just how profitable is a toll booth like this? Well, just look at this number. Operating margins consistently above 40%. Let me say that again. For every dollar in revenue, over 40 cents becomes pure profit. That is an almost unbelievable level of profitability, the kind you almost never see outside of a pure software company. And all that profitability, it translates directly into shareholder returns. S&P Global is what they call a dividend aristocrat. which is just a fancy way of saying it has increased its dividend for over 50 consecutive years. 50! That just screams incredible resilience and a serious long-term commitment to its owners. What's fascinating is how these super investors look at volatility. A recent dip in the stock price wasn't seen as a risk. To them, it was a rare opportunity to buy what they consider a cashier's check, a super high-quality, reliable asset, but to get it at a discount. So that's the breakdown. A business built on decades of trust, incredible scale, and deep, deep integration into the global financial system. And it leaves us with a final thought to chew on. S&P's economic moat was built over a century. As we move deeper and deeper into the age of AI, what is the next great, unassailable economic moat going to look like?